Hey, how's it going, guys? Welcome back to another weekly market update. There are a lot of uncertainties and fears in the market this week. We saw some big selling going on, and the investors getting more and more panic. Is this the right time we should be worried? Or is it just a normal pullback or even a buying opportunity? In this video, I will do a quick update on the US equity market and try to answer all these questions with my own analysis. Also, I will share with you guys what you should be looking at in the next coming weeks. So please make sure you watch the video to the end and don't miss out anything. I promise you I will make it quick and don't waste your time. Alright, let's get started. This week, the stock market continued its correction. S&P was down 2.9%, Nasdaq down 1.6%, and Dow was down 3.3%. On the S&P daily chart, we can see that the 78 Fibonacci retracement level, which is around 3100, has been a pretty strong resistance. We had a breakout from this level about 3 weeks ago, but it failed. For the past 2 weeks, the market tested the 3100 level 4 times and couldn't break it. This is a very clear sign we're having a very strong short-term resistance. Usually when that happens, especially in the short-term uptrend, the market will enter a consolidation range for the next 1 or 2 months. For now, we know where the top of this range is. So the next big question is, where is the bottom of this range? How much more downside this correction can go? No worries, I will answer them in the second half of this video. But for now, I wanted to point out some important highlights in the market this week that you should definitely pay attention to. First is that on Friday, although the S&P index was down 2.4%, but the top 4 index leaders, or the FANG stocks, were all down much more than the index. On the other hand, the Russell 2000 was down only 2%. Normally, we should see the opposite. We should see the small cap index has much worse correction than the large cap market leaders. So what this tells us is that the selling pressure over the market leaders on Friday could be the beginning of a major trend reversal. Of course, we can't make any conclusions just based on one day's price action. That's why for the coming weeks, how these market leaders, the FANG stocks, will perform is an extremely important indicator to watch. Next, we had 2 very interesting breakouts this week. One is TLT, the long-term treasury bonds ETF, breaks out from this triangle pattern. Usually, there are 2 main reasons people buy long-term treasury ETF like TLT. One reason is to buy it as a bond proxy in their long-term portfolios. And another reason is simply for the short-term hedge. For now, this breakout of TLT is more like a short-term hedge against the recent stock market correction. Another breakout is the gold. Gold breakout from this ascending triangle pattern on Monday, stay above it for the whole week with no big up and down swings. This is what I call the textbook breakout. Very clean and very convincing. So these 2 breakouts, Treasury ETF and the gold, are definitely a sign of telling us that there are a lot of short-term uncertainties and fears in the market. When you see these 2 charts, you don't even need to read the news, because these 2 breakouts can already tell you the recent news must be very, very negative. Remember this, the dumb money used the news to navigate the market, but the smart money used the market to navigate the news. No matter if you're a long-term investor or a short-term trader, being able to discover valuable information from a chart is an extremely important skill to have. There's one pretty interesting thing in the market I've noticed recently is that this crazy rally that we're having after the March low is extremely similar to the rally back in 2009 right after the financial crisis. These 2 rallies from the market bottom seem to follow exactly the same trajectory. Let me show you what I mean. Back in 2009, the market bottomed on the 9th of March, and within the next 60 trading days, the S&P 500 went up 37.8%, with the volatility index VIX dropped from 59 to 31. Then the market entered a 6-week consolidation period. This year in 2020, the market bottomed on the March 23rd, and after the next 60 trading days, the S&P went up 39.4%, with the VIX dropped from 61 to 31. Then, as we're seeing now, the momentum of this rally is fading away, and the market seems to enter a consolidation too. Apart from the price action, the market environments during these 2 rallies also resemble each other. First, both of the bear markets were caused by a sudden serious economic shock. Back in 2008, it was a financial system meltdown caused by the collapse of the US housing market. This year, it was the Main Street economic lockdown caused by the global pandemic. Second, both rallies were supported by the extremely dovish government with massive fiscal and monetary policies. Third, the Federal Reserve balance sheet was doubled in both 2009 and 2020. So if we want to know where the market will go in the short term, this S&P chart back in 2009 can potentially give us some important clues. Just to be clear, I'm not making any predictions here. I'm using 2009 purely as a reference to give us a better picture of what we can expect in the coming few weeks. I'm definitely a strong believer that learning from the past is the best way to prepare the future, and 2009 seems to be the perfect fit as a reference based on our current market conditions. Alright, let's come back to the 2009 S&P 500 chart and see what happens in the next 30 trading days after the 38% rally. I summarize all the market actions into 3 highlights to help you have a better picture. First, after the initial strong rally, in the next 30 trading days or in the next 1.5 months, the S&P 500 enters a consolidation range. Although there were big ups and downs, the total return after 30 days was close to zero. So basically, the stock market didn't go anywhere after 1.5 months. Second, the volatility in the 30 trading days consolidation still stays very high, and the VIX was still around the 31 key level. There were 10 days the market moved more than 1% in one single day. 7 of them were down days, and 3 of them were up days. So basically, for every 3 days, the market will have one pretty big move on either side. Especially if you look at those down days, most of them were more than 2% or even 3% one single day crash. That could give investors several false signals that the market is gonna crash again. Although the total return was basically flat zero, those big up and down can be extremely challenging for many investors managing their portfolios, especially for those who believe we're still in the bear market and it was due for another crash. The third highlight I want to mention is that the biggest drawdown for this consolidation range was 7.7%. The market was making one lower high and one lower low. It appeared to be a reversal to another downtrend, but if we extend the lower bound of this consolidation range, we can see that it was actually a major support level. The market retraced back to this level, hit the support, and quickly bounced back. So it was nothing more than a short-term correction. So these are the 3 key highlights for the next 30 trading days after the rally back in 2009. Then the next question is, what we can learn from the past, and what sort of market actions we should expect for the next 1 or 2 months. If the 2009 rally from the market bottom can give us some valuable clues, then we should at least expect 2 things. First, in the next 30 trading days, the market will be trading in a consolidation range. The volatility will stay high. The VIX will stay around 31 level. There will be multiple big up and down swings, but the market eventually will not go up or down significantly. Second, we should expect the market will retrace back the key support level before it goes back up again. So where is this key support level right now? If we use the Fibonacci retracement levels, we can see that this 50 to 61% retracement range was a strong resistance zone during the rally. The market was consolidating in this range for about 1.5 months before the next breakout. In the technical analysis, there's one rule of thumb you should remember is that whenever a strong resistance level is broken, it will become a strong support, and vice versa. So right now in the market, the next strong support level should be this 50 to 61% Fibonacci retracement range, which is from 2800 to 2900 price range. We should expect the market will have a minor correction to this range in the next 1 or 2 months and then bounce back up again. Of course, nothing is certain in the market, especially the current market environment with so many uncertainties. But studying the 2009 market actions can give us a framework or a playbook that helps us make some actionable plans for the short term. So here are some of my thoughts on what I would do. When the market trades between this area from 3100 to 2900, I will not do anything. Not buying anything, not selling anything. This is basically the do nothing zone. When the market breaks the 2900 level and the trades between 2900 and 2800, I will look for long setups and add more long positions. So the risk is, if the market breaks the 2800 and continue goes lower, that will be a very serious sign showing us a potential major downturn is on the way. If that happens, I will close all my long positions and then reassess the market structure again, because that will bring us a whole new different market structure to analyze. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market, and also what are the trade ideas or what investment opportunities that you should pay attention to in the market. If you are interested in the world of finance and business and find my videos been valuable to you, please consider subscribing. Thanks so much for watching, guys, and I will see you guys soon.